We believe optimism over a soft landing scenario may deliver more near-term market gains as inflation declines and central banks look to start easing around mid-year. But we think the risks of an economic slowdown later in 2024 haven't gone away. Hi, I'm Paul Eidelman. I'm the North American Chief Investment Strategist at Russell Investments. Welcome to the Q2 update of our global market outlook. Raphael Bostic, president of the U.S. Federal Reserve Bank of Atlanta, coined the phrase Pent-Up Exuberance in a recent speech. We believe that term captures the mood of markets as exuberance about the surprising robustness of the economy and the potential for Federal Reserve interest rate cuts spill over into investor enthusiasm. Investors who are fearful of a recession in 2023 are being drawn back into the market, and positive momentum may push the S&P 500 index to record highs in the coming quarter. That said, we think the risks of disappointing economic growth are underappreciated. The warning of pent-up exuberance is one we believe investors should carefully consider, as this year's optimism could eventually prove to be excessive. We still think some of the impacts of the Federal Reserve's aggressive rate tightening campaign are continuing to work their way through the U.S. economy. The Fed's caution about inflation being sticky could further delay rate cuts. In our opinion, this increases the likelihood that the soft landing currently priced by markets overshoots into a more significant slowdown. We believe it's more likely than not that the U.S. avoids a recession in 2024, but economic uncertainty remains high. In Europe, economic activity indicators are surprising to the upside, while core inflation is tracking down toward the European Central Bank's 2% target. The ECB has hinted that rate cuts are likely in June, and we believe that the recovery in bank lending in Europe suggests that the region's positive economic momentum can be maintained over the next quarter. In the UK, GDP growth is stagnant and inflation is declining at a slower pace than in other developed economies. Fixed income markets expect the Bank of England to deliver 2 or 3 25 basis point rate cuts this year. This seems like an underestimate to us given the underlying weakness of the UK economy. China has announced a 2024 GDP growth target of around 5%, but without the benefit from another post-pandemic reopening, we believe achieving this target will be difficult without further policy stimulus. Japan is beating expectations in economic activity, corporate profits, and the Tokyo Stock Price Index has been the best performing market year to date. We anticipate trend-like economic growth from Japan through the rest of 2024. We expect Australia's below-trend growth to continue, but think a recession will be avoided there. We expect the first rate cut from the Reserve Bank of Australia at the end of the third quarter. Finally, in Canada, we believe a recession is more likely than not over the next 18 months, with the Bank of Canada likely to start cutting interest rates by mid-year. Next, let's turn to our asset class views. Our view on equities is neutral. The equity market outlook appears constrained by expensive valuation multiples, optimistic consensus earnings growth expectations, and overbought investor sentiment. Our portfolio strategies are neutral across major equity regions. While non-US equities still trade at a significant discount to the United States, we think there is uncertainty around the ability for these markets to deliver differentiated earnings. In fixed income, we believe government bonds provide attractive value, as yields still trade well in excess of expected inflation. U.S. Treasuries are a preferred overweight exposure, where we see particularly good value in the 5-year point of the yield curve. We also see potential for the curve to re-steepen if more aggressive rate cuts are delivered in the next few years. In currencies, we hold a neutral stance on the U.S. dollar. The dollar is expensive, which suggests some potential for the greenback to decline over the medium term, but lingering risks of a global recession in 2024 could cause further upside for the dollar in the short term if investors flock to the relative safety of U.S. assets. Thanks for watching. Visit russellinvestments.com for the full report. We'll talk to you again soon.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.